Chapter 13 covers credits of various kinds. So 13 is, for the most part, fun in the sense that we get to reduce our taxpayers' total amount owed. We do come at the end of Chapter 13 back to some tax payments that have to be made, but for the most part, 13 is about credits. This video is going to be about the business tax credits, and then we'll cover personal tax credits starting on Tuesday, November 4th. But here, business tax credits. So tax credits, first of all, just in general, what is a tax credit? Deductions are subtractions from your tax base, but credits are subtractions from the tax itself. So a $100 deduction will reduce your total tax by $100 times whatever your tax rate is. A $100 credit will reduce your total tax by $100. So that credit, a $100 credit, is better than a $100 deduction. One concept we need to be aware of with tax credits is refundable versus non-refundable. A non-refundable credit can reduce your tax, but cannot reduce it below zero. A refundable credit can actually create or increase your tax refund. So that's nice. It's more than just you don't have to pay the tax. You actually get money back that you never paid in. So for example, Rebecca's income tax before credits is $300. She has a $480 non-refundable credit and a $100 refundable credit. So the income tax, $300, that non-refundable credit of $480, well, that's just going to reduce her down to zero. That other $180, maybe it can be carried over, maybe not. Depends on the specific credit. But she can't take it this year for sure. She does have a $100 refundable credit, and so she gets a tax refund. Even if she paid nothing in, she's going to get that $100 back. General business credit. There's really only one business credit called the general business credit, but it's made up of a lot of other credits. General business credit made up of several other credits. Step one, compute each of your separate credits, however many you have, as if you're eligible, and then add them up. Step two, compute the business credit limit, and that will be done once you've added up all of your individual credits. Then come up with the total limit based on your taxpayer's regular tax liability. And reduce that by certain non-refundable credits, which we will see later on. The child care credit, the foreign tax credit, and there are other types of non-refundable credits that we'll see later. So reduce it by those, and then reduce what's left by the greater of 25% of the amount by which net regular tax liability exceeds $25,000. So not only is the general business credit not refundable, sometimes you can't even get your tax down to zero with that credit. If your net regular tax liability minus those other non-refundable credits that we were talking about, if that's over $25,000, you cannot even get that number down to zero. And if you had a tentative minimum tax, you cannot get your total tax liability down below the tentative minimum tax. So therefore, if you're paying alternative minimum tax, the general business credit will not do you any good at all, because that means your tentative minimum tax is greater than your regular tax liability, and so there's no way you're going to get any general business credit at all. Taxpayer may claim the general business credit up to the limit. Any unused credit, here's the good news, you can carry it back 1 year. You can also go forward 20 years. They do expire after the 20-year forward period is up, but that is 20 years, so hopefully you'll be able to use all the credits within that allowed time. The Internal Revenue Code lists 41 separate credits under the general business credit. We are not going to look at anything close to 41 of them. Exhibit 13.1 names 8 of them, and the 8 that are named in our textbooks exhibit are covered to some extent in the textbook. So there's at least 8 that you can read up on. We're not going to look at 8. We're going to only look at 4 out of the 8. They are the credit for rehabilitation expenditures, the work opportunity tax credit, the research activities credit, and the disabled access credit. So those 4 are the ones we're going to look at, and the only ones you're actually responsible for in this course. You want to know the other 4 that are in Exhibit 13.1. The textbook will give you some information on those. And then you want to know the others to make up the list of the 41, you got to go to the Internal Revenue Code for that list. It's a long list. Credit for rehabilitation expenditures. This is 20% of the cost to rehabilitate a certified historic structure. So if you bought a building and this building is, it's listed on the National Register of Historic Places or located in a registered historic district. And so if it's in the district, then that's probably going to be a qualified, but you got to make sure that it is certified as significant to the district. So it can't be just some little shed somewhere out back. Say, well, it's in the district, so I get to rehabilitate it and get a credit. Not necessarily, but if it's a main building in the district, then definitely it's going to be significant. Okay. Qualify for the credit, rehabilitation expenditures over a 24-month period must exceed the basis of the building. So you've got to really be sprucing this thing up. So you paid $50,000 for it. You got to spend more than $50,000 in order to qualify for the credit. And that amount can never be less than $5,000. So you bought that building, it was really run down, and you got it for $1,000. Well, you got to spend at least $5,000 before you can qualify for that credit. Credit is taken ratably over 5 years, so you don't get the whole credit as soon as you spend the money. You take it over a 5-year period, and you got to hold that building for 5 years after rehabilitation in order to get the full credit. If you sell early, you just lose out on the rest of the credit. You will increase the building's basis by what you spent, but at the same time, you must decrease the building's basis by the full amount of the credit that you claimed or are expecting to claim. So you got to reduce that basis right away. So your depreciation is going to be based on the full credit. And if you sell early and don't get the full credit, you don't get to go back and recalculate your depreciation. It is what it is. Work opportunity tax credit. This one is 40% of the first $6,000 paid to a qualified employee in the first 12 months of employment. Now that could span 2 years. You hired the employee in October, and then it'll be until next October before the 12 months is up. So this year and a little bit of next year. A qualified employee is an at-risk youth, a welfare recipient, a food stamp recipient, a veteran. There may be some others added. This is the main list that I put down here, but again, check the textbook. There may be some other categories in there that I left out. The credit textbook will tell you is only for people who have been employed in 2025 or earlier. So in other words, this thing for anybody you hire next year, the work opportunity credit will no longer be available. Now in the textbook, it says, however, Congress has had these deadlines in the past and they've always extended it. We expect it'll probably be extended. Something like that. There's a footnote in the textbook that says something along those lines. And maybe not quite as optimistic as I just said. But anyway, the July 4th Act that the textbook didn't know about does not extend the work opportunity tax credit. And of course, that was the main opportunity that Congress had to do that, and they didn't. So this may be gone. As of right now, it is gone for any employees hired after this year. It's still available this year and next year for somebody you hired this year. But next year, all you'll be able to do is claim the credit based on people you hired in 2025. And in 2027, there will be no work opportunity credit at all, unless Congress comes back and changes it. They had one big opportunity, didn't do it, so I'm a little dubious as to whether this thing is going to survive much longer. The full credit, the employee has to complete at least 400 hours of service. If the hours worked is less than 400, but not less than 120, you get a smaller credit. Let's reduce the credit to 25%. And of course, whenever you take a credit, there is a cost, and the cost is that your deduction for wages has to be reduced by the amount of credit you took. Problem 1329. Green Corporation hires 6 individuals on January 4th, 2025, all of whom qualify for the Work Opportunity Credit. 3 of these individuals received wages of $8,500 during 2025, and each individual worked more than 400 hours during the year. The other 3 individuals worked 300 hours and received wages of $5,000 during the year. So first of all, calculate the amount of Green's Work Opportunity Credit for 2025. So we've got $6,000 for 3 employees, where the rate is 40%, that's $7,200. And then for the 3 that didn't work up to 400 hours, but they were over 120, they were at 300. So for them, the rate is 25%. They were paid $5,000, and there's 3 of them, so that's the other $3,750. Total, $10,950. Letter B, if Green pays total wages of $140,000 to all of its employees during the year, that includes the wages paid to these 6 employees, plus a lot of others. How much of the amount is deductible in 2025, assuming that the Work Opportunity Credit is taken? So it's just $140,000 total paid minus the $10,950 Work Opportunity Credit, so your deduction is $129,050. Next up, the Research Activities Credit. This one is fun. You'll see why I said that in just a little bit. The Research Activities Credit is the sum of Incremental Research Activities Credit, Basic Research Credit, and the Energy Research Credit. That's not the fun part. Fun part's coming up. The Incremental Research Activities Credit is 20% of the amount spent on the excess research expenditures. The amount spent is 100% of the cost of research activities performed in-house. So your people in your lab did this research. Plus 65% of the cost of research performed for the taxpayer by an independent entity under contract. So you outsource some research to another entity because your lab couldn't do it for whatever reason, let's say. Well, then you get a credit of 65% of the research performed by your external contractor. That amount minus a historic base amount is your excess research expenditure for the year. The basic research credit is 20% of excess payments made to qualified research organizations. So you have to have a qualified research organization to get this. And it's to advance scientific knowledge without a specific commercial objective. Once again, subtract a historic base amount to compute the excess payment, because it's excess payments that are multiplied by 20% to get your credit. Okay, here's the fun part. Calculation of the base amount. What is it that I have to subtract so I can figure out what my incremental credits are? That can be quite complex. The textbook kind of hints at it, and I'm thinking, why aren't they just giving us the formula? They don't tell us that to calculate the tax on taxable income, you multiply, subtract a number, multiply by another number, and then add a third number. No, they give you the numbers. They tell you how to do it. Here, they're just saying, well, there's a formula for figuring out what your base amount is. For details on how the base amounts are computed, they didn't tell you this. I'm telling you this. You can see Form 6765. I went to Form 6765 saying, okay, I'll just lay out what these base amounts are. And then I looked at it and I understood why it was that the textbook didn't want to go there. It's complicated. It's not, I wrote complex here. I should have said complicated. It's really not complex. It's just complicated. But it goes back all the way to 1992, which I think is when the research credits were first created. And so you've got this long formula. What did you do in 92, 93, 94, et cetera, up until last year, and then bring that in. And it is, again, quite complex. And I didn't go through all the details. So if I were going to teach it to you, first I'd have to learn it. And I decided not to go through the process of learning it. It is lengthy. But it doesn't look like it's particularly complicated. It's basically X% of this plus Y% of that. And but it's a lot. It's several years, many, many years. If you've been in business since 1992, you will have about 24 or more calculations, well, more than that, almost 36 calculations to calculate to get that base amount. So, okay, we won't go through the details, and I won't hold you responsible for computing the base amount. Energy research credit is 20% of payments made to tax-exempt entities that conduct energy research. Now, of course, the tax-exempt entities, they're not going to use the credit for anything because they're tax-exempt. There's no tax to get a credit against. But if you make payments to the tax-exempt entities for those research, then you can get a 20% credit on your taxable income. So, and again, that is a credit against your tax. No base amount is used to compute the energy research credit. Thank you very much. You don't have to go back to 1992 to see what you were doing there. Just 20% of payments made to your tax-exempt entities doing the energy research. So that's a little easier. Reduce deduction for research expenditures. That is your total deduction for all three, the incremental research credit, the basic research credit, and the energy research credit. Reduce the deduction by the total amount of the research credits claimed. Finally, the disabled access credit. Purpose of the Disabled Access Credit is to assist small businesses to comply with the Americans with Disability Act. That was enacted under the first George Bush administration, George H.W. Bush, Vice President to Ronald Reagan, and then became president in 1988. And it was in 1990 that he signed the Americans with Disability Act that said that buildings have to be made so that people in wheelchairs and other disabilities can navigate them, because there are many buildings where they simply couldn't get in. They have to go up the staircase. There's no elevator to get in from the ground floor. Things like that. And so we've got all these buildings in 1990 that did not comply with the Americans with Disabilities Act, so they created this credit. Credit is 50%. So half, government will pay half of the expenditures in excess of $250. First $250 is on you. But then up to $10,250, so the next $10,000 after that first $250, you can get half of that paid for by the government. To remove barriers in buildings placed in service before, there's your magic date, November 6, 1990. If you place that building in service after that date, hey, why isn't it already compliant with the Americans with Disabilities Act? And you're not going to get this credit for any non-compliance that you have with the building. You should have fixed it before. So no credit for that. But if the building was placed in service before this 1990 date, and you're still working on it, then you can still get this credit all those years later. Eligible small businesses are those that had gross receipts of less than $1 million or fewer than 30 full-time employees in the previous year. So if either one of those things is true, then you are an eligible small business. And if you're fixing your building all these years later, 35 years later, then you can get credit of 50% on the dollar after you've spent your first $250, up to $10,250. Depreciable basis of the building is reduced by the amount of the credit. That is it for our business credits. The personal credits, we will cover those starting on November 4th, and we'll get through Chapter 13 hopefully by the end of Tuesday, or if not, then we will continue into Thursday.